All right. Good afternoon, everyone. I think we are live, if I am not mistaken. Are we okay? There we go. We are fully live. Good afternoon, everyone. My name is Miguel. I believe a lot of you guys already know me here. I work at Guerra Wealth Advisors. I'm one of the senior wealth advisors here. And today's topic, we are going to be talking about the stock markets, everything that has been happening over the last couple weeks and months, because I could imagine is some of you guys have been loving or hating everything that's happening right now. So we're going to talk about mainly fundamentals and basically the outlook of the stock market. Some of you guys don't know us, but let me share my screen with you. Here is basically who we are. We're Guerra Wealth Advisors. A lot of our clients might be joining us too to hear about the stock market, but like last time, it's gonna be a short webinar because a lot has happened over the last month. But if you guys tuned in to the last webinar, you already know a lot of the things I'm gonna be saying, which we'll also speak about the markets, the outlook, what history tells. Like I was saying, I'm one of the advisors here. I've been with Guerra already around 4 years. Had the blessing of working here alongside Sebastian Castañeda, the other Miguel. Um, Basically today, if you guys don't know us, we have infidelity around $800 million that we manage. We specialize on five specific things. I know our clients are going to tell me, Miguel already know that, but just super quick, we might have some new families here with us, just so they know who we are and what it is that we do. We specialize on retirement income planning, investment management, optimizing the growth of your investments while minimizing the downside. Our today's conversation, tax planning, just minimizing taxes, sending less to the IRS, keeping more in your pockets. I think everyone would like to do that as well. Asset protection, just overall protecting your wealth. And lastly, estate planning. When you're no longer here, basically who's going to be receiving all your wealth, having all your legal documents structured properly. But most of the people that come to us, they come from one of these areas and they're closer to retirements. But today's main conversation will be about investment management, which is area number two. But throughout today's conversation and webinar, I'll be answering a couple questions. And so please drop them down in the under in the comments below, and I'll try to answer them as I can. But let's get into it. Let's talk about the stock markets and what is happening right now. Give me 1 second. So year to date, last time we met, the stock market was down. So year to date, as you guys could see, this downside of what happened to the market after Liberation Day. We'll talk about tariffs in a second. But year to date, the indexes, the major indexes, we're talking about the S&P 500, the largest 500 companies in the United States, the NASDAQ 100, the straight tech, the largest 100 companies, and the Dow Jones, the biggest industrial companies, the largest 30. Right now, the S&P is up 0.29%. And when you look at technology, it's up 1.09%. Tech had actually, if you guys remember our last webinar, the most volatility when it went down close to 20%. And right now, it took the lead over the last couple months and it bounced back. And it's the leader in the leading indicator right now in the out of all the benchmark is doing the best right now. And that's year to date. As you guys could see right now, April, right after the webinar that we had, the market basically went up and went down, and then it bounced back over the last couple of days, which with the latest basically tariff updates. But now let's look at it in a year, basically. Now, over the last year, the NASDAQ 100, still the best one, straight tech, as you guys could see, and I have a lot of conversations with our clients about this. The AI is here, a lot of artificial intelligence. There's a lot of companies that are putting this innovation into the business model, creating more efficiency. And basically, AI is still here. It's showing the fruits behind it. A lot of the companies have shown throughout the earnings over the last couple of weeks that they're profitable and they're still making money. And tech over the last year is up 16.15%, with the S&P 500 following up at 12 and a quarter, and the Dow Jones at 6.34%. Now, some of you guys might be thinking, hey, I'm going to put everything into the NASDAQ 100. But at that point, you don't really have a financial plan. When you create a financial plan, you have to give it a structure, diversify your assets across different sectors and across different asset classes. Now, the NASDAQ is only technology. So if you would have had everything in technology that right now with the last year is doing the best over here in April, and you were taking income out of your portfolio. Let's assume it was invested into into the Nasdaq, which is QQQ. You'll be selling at a loss, even though it bounced back within a month. You might want to diversify your assets, create a different strategy, create your retirement income strategy to withdraw from the portfolios. When the market is up, you might want to take it from one bucket. When the market is down, you want to have the right things in place to withdraw from those accounts. Now, that's over the last year. If we zoom out even more, look at it over the last 5 years. The Nasdaq is still killing it. It's up 132%. The S&P 105 and the Dow Jones right now is up 77%. Still goes back to the same conversation. You cannot have everything in one single index. You want to have a diversified strategy. But when you zoom out and you put the news aside and you start creating a strategy, times like now, you're not as worried. I have met over the last couple of weeks with lots of families, and when we're having these conversations, it usually goes the same. Hey, Miguel, I'm not really worried. I know what percentage of my money is exposed to the stock market and what percentage of my money I could expect to be volatile. And I know most of my money is secure in different things, so I could withdraw money when the market is down because you have a purpose. You have a retirement income plan, which is making sure that you don't have to go back to work. Because if the market goes down, let's call it 20, 30%, and you only one asset class, you might be selling at a lot of losses. So you want to diversify. Now, let's talk about the sectors. I know this conversation, a lot of you guys liked it last time. So in this visual that you see right here, you're going to be seeing all the sectors within the S&P 500. So when we go back to basically the NASDAQ 100, we're looking at only tech. Right now, we're seeing everything that's inside of the S&P. So let's look at it over the last 3 months. Over the last 3 months, one of the main sectors that have gotten affected the most, if you look over here, is the healthcare sector. If you had all your money in the healthcare sectors over the last 3 months, let's assume you had $100,000 there, you're down around $9,000. And year to date, the worst performing sector right now and over the last 3 months, it flipped over the last month, but over the last year is right now consumer discretionary. As I explained last time, consumer discretionary, those are wants, not needs. That sector in specific gets affected a lot by the tariffs. All the imports that are happening right now for companies like retail store, clothing stores, they're getting affected by the tariffs. So the consumer doesn't feel as confident with this sector. So that sector right now, with everything that's happening, the cost of those goods could go up. So that's why that sector went down. Now, over the last couple of months, we spoke a lot about consumer staples. Consumer staples year to date is still there in the leading board. It's the fourth best performing sector, but not over the last month. Over the last month, with the delay, with the change of tariffs and everything that's happening, technology and consumer discretionary took over. If you go down here, information technology is up 16%. Because a lot of those companies import their goods. So right now, by the change and having a clear picture of what's there to happen over the next 90 days, the market like that. So what the market does not like is the unknown. The market wants to know what is happening and what is going to price in over the next quarter and in advance. Now, if we look over here, utilities, that's what is called a defensive sector, still up 4.15% over the last month. If we go down here, healthcare sector, still down 3.84%. And right now, over the last 3 months, a lot of sector rotation has happened. You have to be on top of your portfolio. If you don't have a solid strategy and you're there just letting it be everything in one single sector, times like now might not be the best for you. If you had all your money in one single stock or one single ETF, let's call it, in the healthcare sector, you might be down. You might be missing a lot of opportunity. The bounce back that just happened with the markets. That's why you want to take advantage of the opportunities as they come as well. So you want to have that strategy. Now, before I continue, I want to see if I answer any questions about the sectors of the market. I know last time we had this webinar, most of you had questions when it came to this. So I want to go ahead and go to the comments and see what questions you guys might have when it comes down to the sectors of the stock market. So I see here a question about, give me 1 second. Let's take a look here. What is this question about? Is the market going to keep going up over the next couple months? This is something that I tell everyone. If I had the crystal ball, I wouldn't be here in this position. What you could do in times like now, if you don't feel, let's call it, at peace with what's happening in the market, you want to make sure that your portfolio is diversified. You want to make sure that you have different buckets, like I mentioned, in different asset classes. You cannot be timing the markets, which we'll talk about that now. But you cannot just depend, hey, the market only goes up. The market goes down very often. The market goes down 10% over every year and a half. You have to be prepared for times like now so your portfolio is optimized. So no, I don't know if the market is going to keep going up over the next couple of months. With the new cycles and all the fiscal policies, which is with the governments that are happening right now, there's a lot of changes that are taking place. So you want to make sure you're very diversified in times like now. So let me see if I could take another question before I move on. Let's take a look here. If I see anything. Yeah, so when it comes down right now to defensive sectors. So defensive sectors, think about consumer staples and utilities. Those historically tend to do the best in times like now when there's volatility. Those are needs, not wants. Think about retail companies, grocery store, the light bill, we have to pay for the light bill. That's a necessity in that sense. Those companies in times like now, they tend to still make profits. You just have to understand what are the companies that you're invested into and do they have any exposure to what's happening right now. So right now, just make sure your portfolio is diversified. Be on top of the sector rotation that's happening right now because it happens very fast and you don't want to be left behind. If you want to consult with one of our financial planners, what is happening? How is your portfolio structure? Please reach out to us. We'll set up a meeting and where we could do a dive deep into what's happening with your portfolio. Now, if you're one of our clients and you haven't had a meeting over the last 3 months, you set up a session so you can sit with your financial planner and your advisor and make sure how is your portfolio structure, just keeping up to speed. What has happened with your portfolio? How is it performing? Do you need to make any changes? Most of the times we do those changes, but hey, just speak to them. You want to be updated. At the end of the day, this is your life. It's not only your money, it's your financial life at the end of the day. Now, last time that I had this webinar, I spoke about this, but many of you maybe were not there. So let me re-explain it. Tariffs is nothing new with the economy. They've always been there. Let's just see how the market reacts to tariffs over time. So now in 2002, tariffs were implemented to protect the steel industry. Now, if you look at this graph back in 2002, you look at the S&P 500, how it reacted for the implementation of tariffs, you see the purple. At the beginning, it liked it a little bit. It went down over 20%. Then from May 2002 all the way to September, almost October 2003, the market recovered. So a little bit more than a year, the market bounced back when tariffs were implemented during this time period. Now, let's see if you would have been invested into one single stock that was exposed to these tariffs. Let's look at Ford, how Ford reacted to those news. So back in 2002, when the news came out, Ford liked it. It went up. But in a matter of a year and a half, the same thing, it went down almost 60%. Imagine if 50% of your money was exposed to Ford. That's not good. That's not bueno. You want to make sure that your portfolio is diversified. You don't want to have, and this is not financial advice, but just meet with someone that could advise you and you don't have so much exposure to one single thing. Just diversify your assets at the end of the day. So let's look at the most recent one. Back in 2018, tariffs were implemented by the same administration that we have right now, which is the Trump administration. They were doing the same thing with China. So when tariffs were implemented back in 2018, the market didn't like it. The market went down. The market went down as low as 10%. But again, within a year, basically the market ended up being positive 5.39%. But now, if you wouldn't been invested, let's call into bonds at that time, which is a specific ETF, At that point, bonds were not as volatile as the S&P 500. It ended up being more positive than the S&P 500 during this specific time period. It does not mean that bonds over time are going to be better than the S&P 500. That's not what I'm saying. I'm just giving you an idea of how bonds reacted to tariffs, and if you would have been diversified across two different asset classes, how your money could have performed. Because if you had everything, for example, all your money in the S&P 500, the accounts, your investments wouldn't go down as low as 16.65%. So I know this is a topic that everyone likes to talk about, which is tariffs. I want to see if there's any questions over here. So I see a couple of clients of ours being thankful for our advisors. That's awesome, man. I'm happy that that Eric did a great job for you. That's one of our advisors over here. That's very good to hear. I'll make sure Eric gets lunch for me. I'll buy him lunch. I see one of our other clients that had a diversified portfolio, and in times like now, it's doing good. That's good to hear, man. I believe your advisor is actually Sebastian or Jimmy. So I'll buy them lunch as well for them doing the right thing for our clients. That's very good to hear. So as you guys are seeing, in times like now, like I mentioned, most of our clients, they have peace of mind because they know they have a financial plan. They have a well-structured financial plan to battle volatility. And then when they're taking income out of their portfolios, they don't have to be worrying, hey, do I have to go back to work the day after? Because the market went down 3 to 4% in one single day, which as we know, it went down further than that. So you want to make sure you're basically optimizing your retirement income strategy. And at that point, if you have to go back to work, you do it because you want to, not because you have to, not because your portfolio was not structured properly and your financial plan was not there. And now you're forced to go back to work. You don't want to do that. We believe that working is an option, not an obligation. That's our mindset here in Guerra. Now, this is a fun one. Let's talk about everything that has happened over the last month. I know you guys haven't seen me over the last month, and every time I talk, I don't know why the market goes up. That's not a real thing, but don't get too excited every time you see a webinar that the market is going to go up. It's just my luck when you look at that. So let's do a recap of everything that has happened over the last couple months. So back in February, 10% tariffs were implemented on all goods. Back in March, 20% on tariffs, 25% on steel in February 10th. Now we have March 26th, 25% on cars and parts. April 2nd, they went up drastically to 54%. April 8th, basically tariffs went up as high as 104% and then as high as 145%. I'll tell you this, during this time period, I'll be very transparent. Not many families called us, and I'm very proud to say that because they knew they had a well-structured financial plan. If they wouldn't have understood how the money is structured, a lot of phone calls would have came into our firm, and not many did it because people understand how their portfolio is structured and the overall picture of their financial plan. But look at this. Look at this whole U-turn. It's a bad U-turn. It's down back on May 12th, is back at 30% tariffs with China. So all of this right now has taken a whole U-turn with the stock market. So let's look at the stock market this year on the right side. So the market went up beginning of the year all the way to March. Then it went down with the tariff talk. Then Liberation Day. A lot of clients love that day. A lot of clients hated that day. It just depends what news channel you're watching because it's very divided. You want to make sure you're getting the right information from the right sources. When I say the right sources, talk to your financial advisor. That's why you have them. Don't let the news lead you to make an emotional decision. Sit down with your financial advisor. If it's one of ours, if it's not one of ours, if you have one, hey, make sure he's doing the right thing or she's doing the right thing. Make sure you're understanding how everything is happening right now. How exposed are you to everything that's happening right now? But during Liberation Day, the market went down very drastic. And let's do a hypothetical. If you would have called us, one of our clients or anyone in that sense, anyone would have sold at the bottom of the markets just because they feared of what's happening out there. The headlines got to them. That's what we like to call it. The headlines got to their emotions and they made an emotional decision. The bounce back that happened from April 8th to May 13th was 18%. And the market is positive now year to date. 18% is a huge percentage. If you have $1 million, that's $180,000 that you missed out on the bounce of the markets by you trying to time the markets. That's not good. You want to have a structured financial plan and be ready for times like this. not if, but when times like now happens, which they do happen very often, like I mentioned, every 2 years or year and a half, the market goes down 10%. You want to be ready for that. And you don't want to time the markets. You don't want to be looking for the next peak or the next bottom of the markets. You want to have a structured portfolio, knowing what asset classes and what sectors are you using. How exposed are you to times like now with tariffs? What percentage of your portfolio at the beginning of the year was exposed to tech? What percentage of your portfolio now is exposed to tech? Tech went up 16% over the last month. If you had 30% of your portfolio exposed to tech, that 30% made 16% in a matter of a month. And you participated in most of this bounce back right here. What am I saying? Don't be emotional. Understand the structure of your financial plan. And like I mentioned earlier, if you're one of our clients and you want to sit down with us just to do a refresher of how your financial plan is structured, at the end of the meeting, at the end of the webinar, I'll put the QR code so you could book a meeting with us or call the office. If you're not one of our clients and you want to sit down and see how, if your portfolio had this bounce back or it didn't have the bounce back, and how exposed are you to all these things, just book a meeting with us. We'll do a whole analysis of your portfolio. We'll give it to you, and then that could help you make some educated decisions. Now, I want to take some questions around this topic because I know a lot of people enjoy this topic. Give me 1 second. Let me take a quick look here. Let's see here some questions you guys might have. So let's see some questions that you guys might have. I don't see, for some reason, the questions in YouTube are not coming up. Can you see those questions in YouTube? Do you see them? Okay, so with a portfolio rebalance, going back to that, how should you rebalance your portfolios? It depends on the strategy that you have right now. So how often should you rebalance your portfolio? It depends on the time horizon that you have as well. As you're getting closer to retirement, you don't want to be so exposed to the stock market when the market, let's call it, tanks, and you need this portfolio to give you income to supplement your lifestyle. You don't want to have 100% of your money into, let's call it, equities. You want to diversify. There's different things, which we'll talk about in a second, that you could have, that you could rebalance your portfolio as you're getting closer to retirement, so you're not so exposed and you don't have this volatility and fluctuations within your portfolio. That's what you might want to do. Well, tariffs, man, what can I say? They've always been there. The market reacts very volatile to them. It's a very, let's call it, it's not a steady to the stock market. The market doesn't like the unknown. The market likes to know what's going to happen, like I mentioned earlier. And if there's a clear picture of what the tariffs could be, like back in 2002, back in 2018, in short term, the market does not like it. Once the market adjusts to it, historically, what the market shows is that it goes up. It's just a matter of what is it going to be. And right now, we don't have a clear picture. With this pause that just happened, it seems good, but we want to see the terms. What is actually going to happen with everything? Now, let's talk about fundamentally what's happening to the economy and interest rates. So we had it recently, a jobs report that came out that was very good. The economy was adding a lot of jobs. And then there was a 55% chance before that report that interest rates were going down. And then basically that percentage, that prediction went down to 33%. There's a tool that we use, it's called the CME FedWatch tool, that looks in advance to see what is the market pricing in that's going to happen with interest rates. That's a very good tool that we use. Now, right now, the prediction is 33%. So there's not a really high likelihood that interest rates will go down over the next month. And by September, we should see interest rates going down. But again, a lot is going to happen from now, May, to September. Could it happen earlier? It could. Historically, how does the market react to lower interest rates? So when interest rates go down, that's usually a good thing for the economy. They're injecting more money to the economy to basically cause what is called expansion. What do I mean by expansion? Think about it. Put yourself in the shoes of a small business owner. When interest rates are high, a small business owner, that person cannot go to the bank, access capital, or access as much capital with a good rates. When interest rates go down, the banks tend to lend more money at a cheaper rates. So these business owners could get access to more capital What they should do is they should reinvest it back into the business. Let's say you're a business owner, you get more capital. Now you could hire more employees. You could invest more into your business. By you creating more employments, that's good for the economy. By by employees getting jobs, and by people getting jobs, at that point, these people could go ahead and spend more money in other places. So that's a good thing for the economy historically. When interest rates go down, historically the market bounces back and it goes up. Now, history, it could change, so don't take it as a guaranteed. Absolutely, it could change. Now, here's a prediction on the right side, where rates should be. So by the end of 2025, with the Fed, rates should be around 3.65%. So that doesn't mean if you go buy a house, because I get that question a lot, hey, Miguel, I want to go with our younger clients. I want to go buy another house, or with our older clients that like real estate, hey, I want to get an investment property, but the interest rates are too high. This does not mean that if you go get a mortgage, the rates is going to be 3.65%. It's going to be higher than that. And this is a prediction. Could it happen? Yes. Could it not? Absolutely. We have to wait and see how the economy reacts to everything that's happening right now. And there's a lot of friction, if you guys watch the news, with Donald Trump and Jerome Powell. Jerome Powell, let's call it, he's the head of the Federal Reserve. And right now, there's a lot of, let's call it name calling within the both. Trump wants interest rates to go down to stimulate the economy. That's a good thing. But Powell has been very cautious, because if he lowers interest rates way too fast, that could cause inflation to go up. And then if inflation goes up, then at that point, he might have to raise interest rates again. So we're taking a step back. So he's been very cautious to see what he will do. Right now, with the jobs report, it's a good sign that the economy is doing good. So let's talk about inflation. So inflation right now, on the left side, it went down. So when I say inflation goes down, it does not mean that the cost of goods are going down. Whenever I tell my father, hey, Dad, Papa, inflation went down, he just looks at me. Are you telling me that the cost of goods, they went down? Not necessarily. That's not what inflation means. Inflation, what it does is it measures in advance how fast is the cost of the goods going up. That's what it means. So don't expect, let's call it, the price of eggs, because that's definitely a topic nowadays. Everyone likes to talk about the eggs, to go up so fast. So to go down, I'm sorry. Just be aware that moving forward, as of right now, with the information that's out there, the price of eggs should not go up as fast, hopefully. So there's a lot of sectors and things that are happening in that sense. Now, questions. Let me see if I have any questions over here. So how do we select between the sectors? Very good question. So how do we select between the sectors? So going back to this, so when you're looking at the sectors, right, you have to understand fiscally and monetarily how those policies are affecting the stock market and those specific sectors. So if the government's fiscal policy is gonna, right now, over the last month, if you guys remember, there was a news headline that came out that Trump wanted to basically go ahead and put some restrictions with the microchips. And microchips, that's a sector, that's information. So that sector might get affected. So you have to basically, with what's happening to the economy, shift within the sectors according to the fiscal policies and more with monetary policies. And as well, the main thing, how much profits, how much revenue are the companies that you're investing into making? That's the ultimate thing. And a lot of the companies that we're investing into, they're profitable right now. So let's talk about the stock market right now. Give me 1 second. I'm looking at some questions over here. So right now, this is what's in front of you. So news headlines. There's a lot of headlines out there, and it's so divided, right? Depending on the channel that you watch, it's either very good or very bad. Like I mentioned, you want to make the best decision for your overall finances. So understand how your portfolio is structured. What percentage of your money, like I said earlier, is exposed to all these things. And in times like now, for example, you could do something called tax loss harvesting. That's a very simple strategy that we do for our clients, that you're selling things at a loss, you're locking in some capital gains, and then basically you save money in taxes. You have to be very strategic with it. It sounds very simple. It's not that simple, because there's certain rules with it, the wash sale rule, and then you have to be careful with it. But in times like now, that creates opportunities as well for taxes, tax loss harvesting, something very good that people could do to lock in gains, sell some positions that you might not be very optimistic about, and lock in some losses and do a wash. You don't pay taxes. And then with the sale of the money, you could position it into different things. It cannot be identical. If you do an identical, at that point is what is called a wash sale. And then you defeated the purpose. You don't get to save money in taxes. But that's an opportunity you could do right now. Now, going back to the headlines. Let's look at history. Last time that I had this webinar, I showed this. It's very good. And then history just repeated itself a little bit. The year is not done, but over the last month, as we saw, the market went up, even with the bad headlines. So back in 1977, savings and stocks to vanish. Very scary. Back in 1962, missile crisis, the end of economic hope. Back in 1967, starvation and stocks to ruin. Marketing doom. Stock set to plunge back in 1936. There's so many headlines out there. If you watch these headlines, that might lead you to make a bad decision with your finances. Just understand, like I keep going back to it, understand how your overall financial picture and your overall plan is structured. Now, let's see how the market reacted to these headlines. 1977, stock to vanish. They did not vanish. That year, the S&P 500 ended up being positive 7%. Back in 1962, the missile crisis, the market went up 8%. Look at this one, 1950, market to doom. S&P 500 went up 31%. If you really depend on the news as your main indicator or what's happening in the economy, the news are always selling fear. Doesn't matter who do you like, if you like Trump, if you don't like Trump, if you're Democrat or Republican, the news doesn't matter. They're always selling fear. The more fear they sell, the more eyeballs they get, the more money they make. So just understand that the news are not giving you the full picture. So understand your financial plan. It goes back to that. Now, this right here, it just proved itself again. So let's look at this on the right side. So what happens when you miss the best days of the stock markets? If you invested basically back in 1995, some money in the stock market of $10,000, and you stayed invested during 2008, 2020. This is not up to speed up to now, but this is all the way until 2024. You will have in the S&P 500, $224,000. Now, if you missed the 10 best trading days, which a couple of weeks ago, we saw some very good days in the stock markets, your returns get cut in half. It's very rare for the market to do so good in one specific day. It's throughout the year. That one day that the market did over 8%, we have not seen a day like that going back to 2009, if I am not mistaken, 2008, 2009. So missing that specific day could cost your portfolio a lot of money. So diversify your portfolio, have it well structured, don't time the markets. If you miss the 20 best days of the stock markets, 73% of the gains get wiped out. You will have at that point $60,000 rather than $224,000. Now, very important to understand, over 50% of the best days happens when the market is down, because the bounce back happens very fast and you don't know when the best day is going to happen. So you have to understand that. Don't time the markets, don't sell thinking this is not near the bottom. Understand how your portfolio is structured and based on that make decisions. Timing the market is the worst thing that you could do. Most of the hedge funds are not able to do it. That's why time in the markets beats time in the markets. Warren Buffett even says it himself, don't be timing the markets. Just have a diversified portfolio, the S&P 500, something along those lines. Now, let's talk about how we structure a financial plan and we get ready for times like now. When we here in Guerra, basically we give the money a purpose. What do I mean by giving the money a purpose? There's the cash buckets, there's a safe growth bucket, there's a risky buckets, and these last two, we like to call them luxuries. So if you cannot afford retirement, I'm sorry, you cannot have this. You're the priority. At that point, we have to look at all the things. So this is a luxury in that sense, these last two. When you have money, you have to decide what percentage of your money, according to your time horizon, how close you are to retirement or in need of this money, you're going to have in the risky buckets. What's inside of the risky buckets? Stocks, ETF, mutual funds. Now, what type of stocks, ETF, and mutual funds? Small cap, mid cap, large cap, dividend, REITs. There's many things that's inside of that. It's just a matter of what percentage of your portfolio should you have exposed to those things, and what percentage of your portfolio should be in the lower risk side, which is the safe growth. In these buckets, you have bonds, you have medium, you have long-term bonds, short-term bonds, you have structured notes, fixed index annuities, fixed annuities. You have different things in there that allow you to minimize the volatility of your overall financial picture. When the market is down and you have a retirement income strategy, you might want to be withdrawing from the safe buckets. You might not want to be selling from the risky buckets, but you have to identify what's inside of these buckets and what's inside of these buckets and what percentage of your money is in each. Because right now, if you have all your money into one single portfolio and you don't know what's in there, that's not good. Because at that point, you don't really have a structure. You have just ETF and stocks all over the place. There's not really anything structured. You want to have a structure. Now, what we like to have in cash is anywhere around 3 to 6 months of your expenses for projects or times like now that you might not even want to use your investments to supplement your lifestyle. That's very important to know. Now, I love this saying. Sebastian himself is always saying it over here in the office. Process is more important than performance. How is your financial plan structured for times like when times like now happens, you're ready for that. Not if, but when it does happen. Like I mentioned earlier, the market goes down 10% every year and a half. Every 4 years, the market goes down 20%. It's being ready for those things. Now, I'll take some questions at this point. I see here one of our clients giving a nice, I see one of our clients leaving a nice comments. So how do you select the investments within the buckets or asset class? So that's a very good question. So at that point, here's how we do it. You have a meeting with your financial planner where you guys sit down, you go over all the different options and you map out a plan. Hey, what percentage of the money are we going to have in short-term bonds, long-term bonds, structured notes, index annuities, fixed annuities, REITs, ETF, small cap, large cap? That's something that you sit down with your financial planner and you tailor to your specific needs. You can't just do, hey, let's put everything across the board for everyone. That's not really a plan. You have to have a structure to your specific needs and goals in that sense. Now, give me 1 second. Let's look at questions here. So here's the biggest thing. Here in Guerra, we have a very structured process that we take our clients through and the new families as well. We like to have what is called the discovery meeting, where you get to know us, we get to know you, we ask you a lot of questions to understand your financial picture. In that meeting, there's not decisions that are being made. In that meeting, is just getting the full picture. The next meeting, in my personal opinion, is amazing. The Freedom Plan meeting. In this meeting, you're going to talk a lot about a lot of things. Hey, you're going to get a whole reports of everything that you're doing, good and bad, and things that you should be doing to optimize your current situation. Then after that, if families decide to work with us, we have 4 different sessions. An investment strategy meeting where we map out that strategy with your money. A tax planning meeting, how are we going to set up different things to save money in taxes? It's not only how much the money grows, it's how much you keep. Asset location, tax loss harvesting, different things. If you have real estate, you could implement to minimize money in taxes. Asset protections, having basically an umbrella policy in case of lawsuits, having the right things in places, long-term care policies, all these things. And lastly, a very important one that most of the families need to go through, estate planning. This is your money. You want to stay in control of your money when you're no longer here. You don't want your assets to go through probate. When your money goes to probate, you're losing control and it's up to them how to decide. And you might not want to have that. Now, something that I really enjoy meeting with the families that I work with here in Guerra. Our clients basically get a quarterly check-in. During this quarterly check-in, we review their portfolios, their financial picture. Has anything changed over the last quarter? Any debts, any big expenses are coming up? Are you having a grandkid? Do we want to pay for the grandkid's college tuition? We're tailoring the plan. We're moving the pieces around to make sure that your goals are accomplished. Very important. It's not like, hey, I'll see you once a year. We're not big fans of that because things happen. Your life is going to change. I'm sorry to say your goals might change as well. And you want to stay on top of everything that's happening. So there's a full team here in Guerra. It's not only me. Here's me right here. And that's what sets us apart. You're getting a full team that works on your financial picture. It's not only that you're working with Miguel, there's a whole team aspect of everything. And they're helping you make the best decisions according to your goals and your financial plan. Now, We have over 60 employees, like I mentioned. We manage over $800 million, and we use Fidelity Investments as our custodian. I'm a big fan of Fidelity. That's where even myself, I park my money. And if you guys might want to have a meeting with us, if you're one of our clients, you haven't had your quarterly check-in with us, very important. Scan this QR code. Let's have a meeting with your advisor. If it's me, hey, let's have a meeting. Let's review your accounts. Let's review everything, making sure everything is up to speed. If you're not a client, like I mentioned, and you might want to have a meeting, a second opinion of what's happening or what is that you're doing, have the meeting. Let's see how everything's structured, and then we could give you some feedback. If you're doing everything fine, absolutely, man, thumbs up. If you're doing everything wrong, I'm gonna tell you you're doing everything wrong and the things that you should do to optimize your current situation. Now, I'll take a couple more questions, and then most likely I'll see you guys in about another month. If you guys have any other questions, please drop them below. Let's see over here. Should I retire? That's definitely a good question. Should you retire? I don't know. I don't know your full picture right now. I don't know if right now is the right time for you to retire. I don't know how much money you have. I don't know if you could afford retirement right now. So my advice to you is, hey, sit down with someone that could help you see, hey, how healthy you are towards retirement. Do you have the right things in places to be ready for retirement? And that's actually our saying, retirement ready. So you want to be ready for retirement. If your goal is to retire this year, that's very important to know. You need to have a meeting as soon as possible with someone that could help you analyze everything that's going on with your overall financial picture. Look at everything. Look at your buckets. Look at the things you need to set up in place. How much money do you need out of your portfolio to sustain the lifestyle that you have? Where are you going to take it from your portfolio? If you have 100 stocks in your portfolio, which ones are you going to sell on a monthly basis to supplement your lifestyle? That's very important. Have a structure in place, not just sell or do something wrong. Just have a second opinion. See if it makes sense for you to retire. Hopefully it does, and we could give you some good news. If it doesn't make sense, hey, that's what we're here for. We have to set up some things to be able to get you there. Very good question. Let's take another look here. Blah, blah, blah. Should you, can't see that question so far. Very good question. What do you think is going to happen with interest rates and real estate prices? That's a very good question, man. Now, my big disclaimer, if I had the crystal ball, I would not be here. Felipe, I would not be here. But historically, depending who you're talking to, right? If you look at different places in Florida, for example, there's a lot of inventory. Houses are sitting around maybe for a longer period of time. So you have to make sure you study the area that you might want to buy or you might want to sell, how long are the houses sitting for. And then if this is an investment property, you want to sit down and do the numbers. What is going to be your cash on cash return? What's the cash you're investing into the property? What is the real return that you're getting behind that? And how much profit are you going to have? For example, I just met with a gentleman about a couple months ago. We did this whole massive calculator where we ran a projection with different properties he was looking to buy to see if it made sense and seeing the break-even point. What is the profit he will take? How long he will take to get his first investment back and all those things. So in times like now, you want to make sure you're doing the numbers. If you're buying an apartment for investment purposes, there's a lot of assessments out there. I just met with a family that they own an apartment and they got a $40,000 assessment. That's a lot of money, $40,000. That's going to eat away from the profits. Matter of fact, there's not going to be profits for a while. So now they're thinking about selling it. Well, they have to pay upfront the $40,000. But how those interest rates affect the real estate market, like I said, depends who you talk to. Some people might tell you, hey, when interest rates go down, more buyers are going to qualify, the prices could go up. Some people might tell you, hey, there might be too many buyers, and then prices might stay the same because people cannot afford these prices. The mortgages are too high, and then wages have not kept up with the prices. Because prices over the last, at least in Miami, over the last 5 years, they've gone up over 60%. Right now, wages, if you have a job and your income went up 60% over the last 5 years and you didn't change positions, it's very good but it barely happens. So it depends. So you might want to study the area and make more decisions according to the area. Very good question. Now, you have to understand how that relates to your financial picture. If you're looking for real estate, what is the purpose of the property? Is it appreciation, income? Are you going to accomplish that? So sit down with your financial planner. I know your financial planner. You should sit down with him so to have that conversation. Very good question. So, ba, ba, ba. How do you basically decide how much money to invest into the stock market? Like I mentioned earlier, how much money do we invest into the stock market depends on your specific situation. If someone is buying a house and this didn't need this money to buy a house in the next 5 months, might not be the best time to invest this money in the stock market, but there's other investment vehicles that can make you a decent return until you buy a house. So it just depends on your time horizon. Something you could look into with your financial planner, dollar cost average. Look into the markets at different prices and get into the market little by little. So most people are younger that are not close to basically they're still in the accumulation phase. What they do with their 401ks, their accounts, their dollar cost averaging, they're way in. But if you have a lump sum of money that you want to add to the markets, sit down with a financial planner, then you could give that money a purpose and a strategy, how you will get that invested and what vehicle will you use getting that money invested. But let's see here. Alrighty, guys. It's been fun. Like I said, the market went up. I don't know if it was I was speaking. Don't take it for granted. I don't know when I'm speaking again. If I speak again in June 15, don't think June 14 the market will go up or that week the market go up. I just had that luck. But thank you for taking the time to talk about the stock market. Like I mentioned, I'm just proud to work here. I'm one of the faces of Guerra Wealth. There's many people that work in this team. It's a whole team operation. That's how we make this happen and what sets us apart. If you're one of our clients, just a recap, and you want to have a financial review of your accounts, a wealth review, scan that QR code that I had in there, book a meeting with us, reach out to us, understand how your portfolio structure, if any changes that need to happen, maybe something happened with your life that you haven't shared it with us yet, have that meeting. If you're a new family that don't know us yet, have that introductory call where you could basically get to know us and see how we could possibly help your current situation. But again, it's been a pleasure talking to you guys. Yeah, I see Mina. Yeah, we need to have a meeting to review your accounts. But it's been a pleasure. I'll see you guys around in about a month. And again, I'm blessed to be here talking to you guys about the stock markets. Hopefully, over the next couple of months, a lot of you guys make money, and overall, you guys have peace of mind with the way your money structure. So if you don't have peace of mind with the way the money structure, make sure you talk to who you're working with at the end of the day. All right.